I am really happy to be talking to Robert Bernabe. He is former president of E-Trade Mortgage and H&R Block Mortgage and author of a fantastic book called Mind Your Own Mortgage that I'm holding up here, one of the best books I've read about how to find the right mortgage for you at the right price. Rob, thanks so much for making some time to talk today.
Gosh, Matt, thanks for having me. I'm really excited to talk to you today.
You know, I love so many aspects of your book. One of the things you say in it is that a mortgage really should be a commodity, that a 30-year mortgage is a 30-year mortgage is a 30-year mortgage, and yet it seems more complicated than that. Why does it seem so much more complicated?
You know, this is a central theme of the book, and it seems complicated because it's purposely made that way. In business ventures, we have what's called the supply chain, and the supply chain is really the food chain. So in the mortgage world, the food chain starts with people that are providing the money, called investors, and it goes through several steps through banks and different institutions until it gets to the consumer. And in that process, it's a commodity. It's just a pile of money. It's very simple. It's traded like a bond is in the open market. And the problem is that when it gets to the interface of the consumer, it's purposely disrupted. And if you think about the business reasons for that, they're really simple. If it was like airlines, it would be really easy to see who has the cheapest seats.
You say that a mortgage should be as easy as shopping for a gallon of gas. How do you make it as easy as that?
If we accept the premise that a 30-year, let's say, fixed-rate mortgage is the same, regardless of what lender provides that product, because the money all comes from the same place, well, then it comes down to price. And price is very simple. You're paying a rate, and you're paying something to obtain that rate. It's two numbers. It's the rate and the cost to obtain the rate. It's as simple as that. And now it becomes like a gallon of gas, because if I go and get 3 quotes on the same day from a lender, from 3 different lenders at the same rate, it's a matter of picking the lowest cost to obtain that rate. And that's just as simple as gasoline. It should be no more complicated than that.
You give people some very helpful tools both in your book and on your website, mindyourownmortgage.com. One of those tools is what you call the Mind Your Own Mortgage quote comparison process or tool. What is that, and how does that work?
The tools that we provide at Mind Your Own Mortgage are a quote process that are based upon how lenders every day price their mortgages. They enter the information based upon a full application. And then once that information is digested and put into the system, Mind Your Own Mortgage website, as long as you're a member, and the membership is free, will give you what I described earlier today, Matt. It will take all those numbers that used to look like an invoice on a car in the 60s and bring it all down to, you know, the rate and the cost to get it. Not like all the different costs for formats, whatever else. Really simple. We make it simple.
You mentioned the importance of shopping on price, not on payment, yet I think we're all so accustomed to shopping on how much is the monthly payment going to be. Why is it important to shop on price?
You know, when we shop for groceries, we shop on price usually. When we shop for anything almost that we don't finance, we shop on price. The problem in the American household from a credit standpoint is when something's financed, we tend to shop on payment. And if we shop on payment for a car or a new stereo system, or particularly a mortgage, considering how large of a liability that is, you're going to get yourself in trouble because it masks what you're actually paying for the product.
There's certain terms that are unique to every industry, such as the mortgage industry, like points. What are points, and do you recommend that people pay points or not?
You know, it's interesting. It's a great question, and it's something that confuses people, and quite frankly is part of the purposeful disruption of the information to make things complicated. But all points are simply this. A lender on a particular day will set a base price based upon the rate in the open market. And so let's say that rate is 4.5% at 0 points. What they'll do with their rate sheet, they call it, for a particular mortgage is say, my rate today is 4.5% at 0 points. And if you want to take a lower rate, I'll charge you points. If you want to take a higher rate, I'll give you some money back. The objective for the lender who's priced honestly is that whether you pay points or you get something back going up or down from that 4.5% base rate, the profit to the lender is exactly the same. And again, this comes down to, for a particular rate, what are the costs to obtain that rate? Points and everything else. And now it becomes a simple exercise. And what we do at Mind Your Own Mortgage is we ask lenders to give us the entire rate sheet, all the rate and point options. What that stops the lender from doing is thinking, okay, you call in and you like that 4.5% rate, but you don't know the market price is 0 points, and they squeeze another quarter point out of you by quoting you 4.5 and a quarter to the rate. You pay too much. So our process stops that and makes the issue of points very simple.
You also take a stand on whether people should pay fixed rate or adjustable rate mortgages. You like the fixed rate. Why is that?
Well, first of all, is the adjustable rate mortgages are what got us into this economic mess, this crisis that we're in. And this gets back to the payment. You know, you buy a house and that adjustable rate mortgage, that short-term note that's going to change later is priced lower than the fixed rate. When it comes to mortgages, the longer that you're going to be guaranteed a rate, the more you're going to pay in rate. But the reality situation is that a fixed rate mortgage guarantees something that's very important, and it guarantees the primary reason you're buying the home, and that is to hedge inflation. A hedge is something that stops inflation from causing a problem for your family. Everything else goes up, your groceries, your utilities, everything else. When you get a fixed rate mortgage, that means your payment's fixed. So 10 years from now, compared to rents and everything else, your greatest financial outlay is fixed and you have peace of mind. And quite frankly, today we're in a 50-year interest rate trough, which means we haven't had rates this low in 50 years. Why on earth anybody would get anything else is beyond me. It just doesn't make any sense whatsoever.
You also recommend that people work with direct lenders as opposed to mortgage brokers. That feels a little counterintuitive to me. It feels like if you go with a broker, they're going to have access to more possibilities, maybe get you the better deal. Why do you prefer to see people work with a direct lender?
A common misunderstanding in the mortgage industry for consumers is that a mortgage broker has access to so many different lenders, they can probably get a better price. Well, that's not true for one simple reason. They're a step away from the process. They just arrange for the credit, and they're actually working mostly with a direct lender that you could get the loan from directly. And unlike other industries, the mortgage industry doesn't protect their distributors. So if I'm offering mortgages directly to the public and also taking mortgages from brokers, I may price lower than a broker. I'm not going to protect their market. It doesn't happen in the mortgage business. So I would say that it's important to get a quote from at least 3 lenders, and one of them can be a broker. But I will tell you that if you do your homework and shop around and you find a good direct lender, they're going to beat a mortgage broker every day of the week.
Interesting. I never would have assumed that. So I love some of these insights that you have in the book that kind of take a peek behind the curtain, so to speak, in the mortgage industry and really guide people through the process. You talk about 3 factors, the 3 factors that will have the greatest impact on whether somebody will qualify for a mortgage in the first place, and if they do, what sort of rate they'll get. What are those 3 factors?
The 3 factors are credit, income, and value. Credit is your credit score, income is how much you make relative to how much you're borrowing, and value is the value of the home. On the credit side, there's a score called FICO. Most people know that. It's a household term these days. These days, if you're at a 740 FICO or above, you're considered gold credit. Your credit history impacts your credit score. If you've paid your bills on time and you've been a good citizen with respect to your debts, you're generally going to have a good credit score. The higher the credit score, the less risky you are, the lower rate you're going to get. It works the same way with income and value. The more income you have, the lower your bills are in relation to your income, the better price you're going to get or rate you're going to get on your mortgage. And lastly, the value of your home. The less you borrow against the value of your home, the more secure the lender is because you have equity in the home, the better price you're going to get. And those 3 work interchangeably to determine for any particular rate how much you'll pay for that rate.
On the income side of that, one of those 3 factors, is it current income? Do you just need to show a pay stub to show that you are gainfully employed and here's my income, or do you need to show something of a work history?
Work history is really important. If you think about it from a lender standpoint, you're trying to look at the borrower and say, well, how stable are they in their financial life? And one of the indications of stability is time on the job. So they're going to look at time on the job and consistency, and they're going to look at least 2 years of income and the consistency of the income.
And what about for someone who is self-employed? Does that tend to work against that person in the mortgage process?
It does. I'm so glad you asked that question because it's a pet peeve of mine and kind of sense that was coming. You know, self-employed individuals, if you roll back the clock to years ago, where there was a wider range of products available, we had a product called stated income in the industry. And what that meant was a self-employed individual typically has a hard time documenting their income. And the reason for that is a lot of self-employed individuals might have some expenses for the business, but more likely they're contributing to pensions and retirement that make their financials look different. And they can be cash rich but income poor, so to speak, on their income tax return. And so what the industry came up with was, hey, if the guy's borrowing, let's say, only 50% of the value of the home, we don't really care how much he makes, because if he doesn't pay us, we can take the house and sell it, and he loses the house. Today's environment, and this is the problem, is the government now runs Fannie and Freddie because they own it. And the government kind of controls the mortgage market and the rules. And stated income became a very dirty word, and so the pendulum has swung all the rest of the way to the other side, to where before the industry got a little crazy with stated income. They let you borrow 90% of the value of your home. Well, now you can't borrow 50% of the value of the home. And the irony is that you could be providing a job for someone who works for you that gets a consistent paycheck, and that guy can get a loan, but you can't because you're self-employed. It's a problem, and it's actually thwarting to a large extent some of the housing recovery.
On your website, you've got a number of tools. You've got articles, videos, forms. Give me a sense of what specifically somebody would find on the website, mindyourownmortgage.com, that'll help them through the process of getting the right mortgage at the right price.
Sure, I'd be glad to. There's several tools. There's tools to help you shop that we described earlier, that basically at the end of the day you're going to know for as many lenders as you want to get a quote for, you're going to have your rate and you're going to have the amount to obtain that rate. And one of the things I have to say about the tools with the shopping process is that you might find that a lender may not want to fill out the information. They want to give it to you their way. If they do that to you, I would submit it has nothing to do with my website. It has to do with the fact that they don't want to give you the information you want, the way you want to see it, because you're probably going to expose something they don't want you to see. And so when you smell a rat, you run. And that's one of the big values of this website, because it's really independent. The membership is free, and I have no interest in any lender out there. My only interest is for people to read the book and do a better job with financing their homes. That's a big tool. The other two tools help you pay off your mortgage faster through two processes. One is a mortgage dashboard where you enter your information about your mortgage, and if you have an extra $50 lying around at the end of the month, or it's not lying around and you're thinking, well, you're going to go blow it on something, you can plug that into the model, the dashboard, and you can see immediately how much quicker your mortgage is going to pay off, and it kind of snowballs over time. Every dollar you pay against your mortgage, particularly in the first 5 years extra, has a 500% return on your money, and it's guaranteed. I haven't seen a guaranteed 500% return on your money. I don't think you have either, right? And the other thing, Matt, is that we have a refinance analysis tool that allows you to determine on an independent basis if any refinance you're considering is going to accomplish the objective of making your payoff date come early and saving you interest over the life of the loan. And that's an extremely important tool, because going back to payment, when someone comes to you and you've been in a mortgage for 5 years, you got 25 years left to pay, and they put you in a new 30-year loan, they can lower your payment, and it sounds like you're saving money, but you're not, because you just borrowed for another 30 years. The average age of a person refinancing in the United States is about 48 years old. 48 plus 30 is 78. I don't want a mortgage when I'm north of 60. This tool is going to help you to avoid that.
Such good stuff. The book is Mind Your Own Mortgage. The website is mindyourownmortgage.com. The author is Rob Bernabe. Rob, thanks so much for your time. I really appreciate it.
Thanks for having me, Matt. It's always great to see you.